Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. All right, Sandy, it looks like we've got some interesting numbers to discuss today, starting with the latest housing start figures released by the Canada Mortgage and Housing Corporation. Housing starts have really taken a tumble across Canada, Ontario, and right here in Windsor. In Windsor alone, we saw only 24 new single-detached homes and 32 multi-unit projects begin construction in October, totaling 56 housing starts. That's a significant drop of 63% compared to last year. What do you make of this?
It's quite a dramatic decline, Steve. Last October, we had 57 single-detached homes and 94 multi-unit projects breaking ground in Windsor. This decrease is definitely concerning, especially when you consider that Windsor's market has been relatively strong in the past. It seems like the slowdown is pretty widespread too, with Ontario seeing a 35% drop. What are your thoughts on the factors that might be contributing to this decline?
Well, Sandy, it's a combination of several factors. Rising interest rates are certainly playing a big role, making it more expensive for developers to finance new projects. There's also the impact of inflation and increased construction costs. Across Ontario, we saw 970 single-detached homes and 2,597 multi-unit projects start construction, which is down from 1,288 and 4,213 respectively last year. The numbers across Canada aren't much better, with a 17% drop in the seasonally adjusted annual rate of housing starts. It's a challenging environment for developers right now.
Absolutely, Steve. And while these numbers are concerning, they also highlight the need for strategic planning and adaptability in the real estate sector. Market conditions are always changing, and it's essential for investors and developers to stay informed and be prepared to adjust their strategies. It's not just about the numbers, it's about understanding the broader economic context and how it affects the market.
That's a good point, Sandy. It's crucial to look beyond the immediate figures and consider the long-term implications. While the current numbers are lower, they don't necessarily spell disaster. It's an opportunity for those in the industry to innovate and find new ways to meet housing demands while navigating these economic challenges. We'll have to keep a close eye on how these trends develop in the coming months.
Let's talk about the recent TD survey that highlights how Canadians are adjusting their spending in anticipation of higher mortgage rates. It's quite revealing, Steve. Nearly half of Canadian homeowners expecting to renew their mortgages soon are bracing for larger monthly payments.
That's right, Sandy. With interest rates having been at historic lows during the pandemic, a lot of these mortgages were taken out at that time. Now, as they come up for renewal, homeowners are finding themselves in a bit of a financial squeeze. According to the Bank of Canada, about 60% of all outstanding Canadian mortgages will renew in 2025 or 2026.
And the survey points out that 73% of those surveyed are planning to cut back on expenses to manage these higher mortgage payments. It seems like a lot of people are really feeling the pressure to adjust their financial plans.
Absolutely, Sandy. It's interesting to note that 43% are considering delaying home renovations, which makes sense given the rising costs in most of Canada, except for Ontario, where there's been a slight decrease. But it's not just renovations. Some are even considering more drastic measures like selling their homes to downsize or moving to more affordable neighborhoods.
It's a tough situation for many, Steve. The emotional toll of possibly having to leave a home or neighborhood you're attached to can be significant. But it's also about making smart financial decisions in the face of economic uncertainty.
Exactly. The survey also highlights that a significant number of prospective homebuyers are cutting back on unnecessary expenses and even considering cashing in investments to fund their purchases. It seems like people are really weighing their options carefully, evaluating fixed versus variable rate mortgages as well.
Three-quarters of those surveyed are leaning towards fixed-rate mortgages for the predictability they offer. It's all about balancing security and flexibility depending on one's financial situation and goals.
That's a good point, Sandy. Fixed rates can be appealing for those who need stable monthly payments, but variable rates might still offer lower interest for those who can handle a bit of fluctuation. It's about finding what fits best for each individual or family.
And yet, only 35% of those surveyed have sought advice about homeownership. It seems like there's a lot of room for education and guidance here, especially from professionals who can tailor advice to each situation.
Definitely. Access to professional advice can make a big difference in easing the stress of these financial decisions. As Patrick Smith from TD pointed out, there's no one-size-fits-all approach, and having the right support can help Canadians navigate these challenges confidently.
Let's delve into the latest developments with the Bank of Canada, Steve. It looks like they're on track to maintain the current interest rate despite some ongoing pressures from shelter costs.
That's right, Sandy. Economists are predicting a rate hold in December, even though inflation cooled off less than expected in October. The Consumer Price Index, or CPI, eased to 2.2% year over year, slightly above the consensus of 2.1%, but still down from September's 2.4%.
It's interesting to note that while headline inflation is dipping, there are still some stubborn components. Douglas Porter, the chief economist at Bank of Montreal, pointed out that despite the headline and median inflation rates cooling, the underlying metrics are still above the bank's comfort zone.
Yes, Porter highlighted that insurance costs and cell charges have shown persistent strength, which isn't great news. He suggests that these elements are contributing to why the Bank of Canada might be moving to the sidelines come December.
Derek Holt from Scotiabank was even more direct, saying the details of the report don't really matter for policy at this stage. He believes the Bank of Canada is sidelined for the next few meetings.
And Andrew Grantham from Canadian Imperial Bank of Commerce echoed that sentiment, suggesting that there will be no change in the overnight rate through the end of next year. It seems like the markets are reflecting this view too, with the 5-year Government of Canada bond yield remaining steady at 2.75%.
Despite some easing in grocery and gas prices, other components like homeowners insurance and rent inflation are still running high. For example, homeowners insurance is up 6.8% year over year.
Exactly, Sandy. And rent inflation has accelerated to 5.2% from 4.8%, while property taxes are also up 5.6%. Passenger vehicle insurance premiums and cellular service prices have seen increases as well.
TD economist Andrew Hensich noted that while some inflation measures are cooling, others are heating up. It seems like there's a mixed bag of data, which complicates the overall picture.
That's true, Sandy. Hensich suggests that despite these mixed signals, inflation is unlikely to fall below the target band's lower end due to ongoing supply-side disruptions. But it's also not expected to sharply accelerate due to weak domestic demand.
So, the consensus seems to be that the Bank of Canada will maintain its current stance unless there's a significant change in economic growth or price pressures. It sounds like economists are expecting this hold to last through next year.
That's the general outlook, Sandy. Most experts agree that it would take a longer period of easing price pressures combined with signs of economic growth deteriorating to prompt the bank to cut rates again.
Let's move on to the latest data from the Canadian Real Estate Association regarding home sales in October. It seems like the market's been experiencing a bit of a slowdown compared to last year, with a 4.3% drop in the number of homes sold.
That's right, Sandy. Despite this decrease year over year, there's a bit of positive news in the short term. Home sales actually ticked up by 0.9% on a month-over-month basis, continuing a trend of increases in 6 of the past 7 months.
Sean Cathcart from the Canadian Real Estate Association mentioned that this uptick in activity is in line with the trend since April. He also pointed out that, with interest rates now approaching stimulative levels, we might see more activity heading into 2026, though economic uncertainty could temper this.
It's interesting to see how different regions are performing, Sandy. For instance, British Columbia, Alberta, and Quebec led the month-over-month increase in sales, whereas Ontario, Saskatchewan, and Manitoba saw declines.
And it seems like inventory is playing a significant role here. New listings were down 1.4% month over month, and in some areas, this has led to a seller's market. For example, Chad Eamon, a real estate agent in Regina, has observed that good properties often receive multiple offers.
That's a classic sign of a seller's market, Sandy. Buyers are facing tough competition, and it can be quite exhausting for them. It's a bit of a grind, as Eamon mentioned, especially when a well-priced property comes on the market.
On a national level, there were 189,000 properties listed for sale at the end of October, which is actually up 7.2% from last year. It's a bit of a mixed picture, isn't it?
It is, Sandy. TD economist Rishi Sandhi commented on this recovery narrative in the housing market, although he did caution that sales levels are still low, so it's not quite a robust recovery yet. He expects sales to continue rising slowly, driven by pent-up demand and potential improvements in job markets next year.
When it comes to prices, the national average sale price in October was $690,195, which is down 1.1% from a year ago. But there's been a slight increase of 0.2% between September and October this year, according to CREA's Home Price Index.
Exactly, Sandy. Sandhi believes that this improving demand backdrop should keep the average home price growth in positive territory, supported by tight supply and demand balances across most of the country. However, he also noted that in British Columbia and Ontario, market conditions are favoring buyers, which might restrain price growth.
Let's dive into the recent developments regarding the province's plan to take over the Real Estate Council of Ontario, or RECO, Steve. It seems like this move has garnered support from key real estate groups.
That's right, Sandy. The Ontario Real Estate Association and the Toronto Regional Real Estate Board have both expressed their backing for the province's intention to appoint an administrator to take control of RECO. This stems from the issues highlighted in the handling of the iPro Realty scandal.
The iPro case certainly raised some eyebrows. According to a recent report by Dentons Canada LLP, there were significant issues with RECO's practices and procedures, particularly in how they dealt with the financial shortfall in iPro's trust accounts.
Indeed, Sandy. The former registrar's decision to opt for an undertaking agreement instead of the usual suspension or freeze orders has been a point of contention. It seems this approach was taken to facilitate the sale of iPro's assets, but it deviated from RECO's typical protocol.
And now with the province stepping in, it looks like there's a push to get RECO back on track with its consumer protection mandate. The real estate groups are quite supportive of this move, emphasizing the need for transparency and accountability.
Absolutely. It's crucial for maintaining public confidence in Ontario's real estate market. However, this situation also highlights the importance of having robust regulatory frameworks to prevent such issues from arising in the first place.
On a more personal note, it's disheartening to hear from realtors like Maria Flores, who are directly affected by these failures. Many agents are still waiting for their earned commissions, and it's taking a financial toll on them, especially during the holiday season.
It's a challenging situation for sure, Sandy. But it's also a reminder of the broader implications of regulatory lapses. Ensuring that such incidents don't repeat requires not just immediate action, but also long-term structural changes.
And with protests planned, it seems like the pressure is building for a swift resolution. It'll be interesting to see how the province's involvement might change the dynamics at RECO.
Definitely, Sandy. The outcome of these developments could set a precedent for how similar issues are handled in the future. It's a situation that requires careful navigation to balance immediate needs with long-term goals.
Let's wrap up today's episode by looking at the best mortgage rates in Ontario for 2025. According to Forbes Advisor, they've evaluated a range of options from banks, monoline lenders, and credit unions to find the best rates available in the province.
That's right, Sandy. With home prices still high in Ontario, averaging over $850,000, finding a good mortgage rate is crucial for anyone looking to buy a home. It seems like Alterna Bank, CMLS Financial, and Laurentian Bank of Canada are leading the pack with competitive offerings.
Alternabank, for instance, is noted for its comprehensive portfolio of low rates, especially for 3 and 5-year terms. They also offer incentives like up to $1,000 to cover switching or legal fees, which could be a nice perk for prospective buyers.
CMLS Financial, now part of Nesto Inc., stands out with a wide selection of fixed-rate mortgage terms. Their 3-year and 5-year rates are particularly competitive. It's a good option for those with good credit looking for a variety of term selections.
And Laurentian Bank offers some less common term options, like 18 months or 8 years, which can be tailored to specific home buying needs. It seems they're providing a full suite of banking services alongside their mortgage offerings, which could be appealing to those looking for convenience.
It's important to remember that while these rates are attractive, they're not guaranteed for everyone. Factors like your credit score, down payment, and overall financial situation will influence the rate you can secure. It's always a good idea to shop around and negotiate for the best deal.
Absolutely, Steve. And with the Bank of Canada recently cutting rates, there's hope that mortgage rates might continue to ease slightly, making it a bit more affordable for buyers. But as always, it's about finding what suits your financial goals best.
That's the key takeaway, Sandy. It's about balancing the numbers with your personal situation and being informed about your options. Speaking of being informed, it's time for us to sign off for today. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.